And we're delighted that today we're going to hear from Steve Forbes. And yeah, that's great. He consented at the last minute to join us, and he did have a meeting with President Obama, but he canceled so that he could be here with us. Anyway, we're delighted to have a nice large group here for the luncheon and to hear Steve's. He's going to speak on the same topic that we asked Charles to speak on, an insider's view of Wall Street. Steve Forbes, of course, has lived almost his entire life in the New York area, and so he's quite familiar with the players on Wall Street. You can tell from the writing of his books, he's very on top of what's going on there. And so I asked him to comment specifically on Wall Street's reaction since the financial crisis of 2008, since the Bernie Madoff scandal, what has happened there. Maybe if you can comment about the growing power of the SEC and what influence that has on investors. And finally, the whole area of financial regulation, this new regulatory bill that's working its way through the Senate and the House, what impact will that have? And are we going to see a never-ending bear market? That's the concern I think a lot of people have on their minds. So let's give a warm welcome and hear from Steve Forbes, followed by we will take questions from the audience. So if you have questions in mind, be prepared to ask that. C-SPAN here is here to cover this, so you will be on TV to ask a question, and we look forward to hearing Steve's comments. Again, let's give a warm welcome to Steve Forbes.
Well, thank you very much, Mark. I'm no real substitute for Charlie Gasparino, who truly is wired inside Wall Street. He would put the CIA to shame in terms of being able to ferret out information that others don't want to have to be ferreted out. So I'm privileged to be here for him and just ask your indulgence. As Mark indicated, in terms of Wall Street, it has been blamed for the financial crisis, which is very convenient for the political authorities in Washington who truly did cause the financial crisis. What you saw on Wall Street was not excusable, the excesses, but they could not have taken place if Washington had done its part. And one of the things about the financial reform bill is that it indeed does not address the true causes of the crisis. If this bill had been enacted, or some variation of it, we don't know quite what's going to end up happening, but if some variation of it had been enacted 5 or 10 years ago, we still would have had a financial disaster in the latter part of this decade. Just to quickly hit on that, it was excess money creation by the Federal Reserve. If the Fed had not printed so much money, you would not have had the liquidity to finance what you saw. If Fannie and Freddie, two government-sponsored enterprises, had also not been around, they would not have been in a position to guarantee $1.5 trillion of suspect paper. Without those two entities, again, the bubble could not have reached the size that it did. Another thing to keep in mind is that when you get inflation, when the Federal Reserve prints too much money, you get massive distortions in the economy. You get certain sectors that are starved for capital. You get other sectors that have a flood of money temporarily coming in, which they then take as a permanent state of affairs, and then you get the kind of outsized bonuses that you saw on Wall Street. None of you are old enough to remember the 1970s. Yeah. Some habits are hard to get rid of, flatter an audience. Yeah, pandering's good if it gets you votes, but it didn't. But in terms... That's why I'm here for a free lunch. But in terms of the 1970s, when you had that excess money creation, where did that money go? It went first into commodities, so the energy industry had a huge boom. When the inflation was killed in the 1980s, Texas went through a virtual depression. All of the major commercial banks in the state of Texas were destroyed in the mid-1980s when that inflation was ended. You saw it also go into commercial real estate and into the agricultural sector, particularly farmland in Iowa. And so that had a huge run-up. That crashed in the 1980s, which caused huge distress in the Midwest, particularly in Iowa. This time, of course, it went into housing, and with Fannie and Freddie and others there ready to underwrite junk mortgages, the federal government also encouraging a new kind of mortgage. The new mortgage was, why have an income? Who needed it? After all, the asset of the house was, the value of the house was still going to go up, and so you had a classic bubble. Wall Street was a huge beneficiary of that bubble. Wall Street began to believe in its own financial models that you can actually model out risk. But those models, as you know, are predicated on past behavior. There was no past behavior to really parallel what actually happened in the mid part of this decade. Massive amounts of money going into housing, massive amounts of speculation, not just in a certain region, but around the country and indeed around the world. And then at the same time, to be blunt, Washington did not keep up the rules of the road. Rules of the road mean that when changes come, when innovations are introduced, you must put in new rules to take cognizance of it, to recognize it. I mentioned earlier today about the automobile. When that was invented, you had to have speed limits, you had to have rules on the state of your automobile, had to have the highway patrol, new kinds of insurance, all of these things to bring to keep the rules of the road up to date on change. When these exotic instruments came along, thanks to technology on Wall Street, the regulators did not update the rules of the road. You take credit default swaps, for example. And I know this is controversial, but all those are souped-up versions of things that we've had forever, such as soybean futures, interest rate futures. And on those, you have, again, sensible rules of the road. You have sensible margin requirements. You have clearinghouses, so you know what the actual volume is. So to be blunt about it, there was a lot of abuse, I think, in credit default swaps when this crisis came in terms of giving an impression that certain entities were in more, their bonds, their debt was in more trouble than it actually was. You see it again playing out in sovereign debt in Europe. So again, transparency is the key. So in terms of updating the rules of the road, where does this reform bill go? And then we'll get to the Q&A. In terms of the Federal Reserve, it is silent. Nothing on monetary policy. Fannie and Freddie, absolutely nothing. Congress promises it'll deal with it in the future. Right. And the IRS will go out of business in next week. Right. We'll do it with the IRS in 2012. But in terms of the two big causes, the bill is silent. Then on other things, the bill actually makes certain things worse, too big to fail. Although it ostensibly is supposed to fight that, it in effect picks out a handful of major institutions that are going to get special treatment. This is going to be a massive increase for government because government is going to determine whether you are a systemic risk and therefore whether they can intervene, shut you down, provide you with more capital or force more capital to go into you. These are not set rules of the road. They're in the hands of bureaucrats. At the same time, it does nothing to address the problem of small businesses getting credit in terms of the banking system because the regulators still have the mindset of mark-to-market accounting, which is the equivalent of selling your house. What price would you get for your house if you had to sell it in the next 6 hours? You wouldn't get much of a price, distressed market. So in terms of regulatory capital, valuing regulatory capital, the bill is largely silent and allows de facto mark-to-market accounting. Remember, $500 billion of the losses that occurred in 2008, 2009 in financial institutions, $500 billion was not actual cash losses on bad paper, subprime mortgages or exotic instruments. It was write-downs of perfectly good assets. They were book losses, artificial losses. In March of 2009, that was somewhat corrected on mark-to-market accounting, and when it was, that's when the financial markets came back to life. When Congress announced in early March that it was going to hold hearings on mark-to-market accounting, which got no publicity because it's a boring subject, but nonetheless, the markets paid attention to it. And when that announcement was made is when the stock market came off of its lows. As you remember, the S&P 500 was down to 666.